Hey everyone, this is Mark Scribner from Carson Wealth. I'm a managing director, advisor, and partner. Today, we're going to do a quick hit with a colleague of mine. Really exciting time in our industry. We have Jake Bleicher from Carson Wealth Management. He's the PM. He covers an AI strategy that we use, as well as a couple other portfolios that he's actively involved in every day. I thought it would be awesome to get Jake on today because he's deep in the weeds with what's going on in the AI space and how people are capturing some of the investment opportunities there. So, Jake, awesome to see you. I figured we could maybe start with you real quickly, talk about kind of the space, the opportunity, and why it could be interesting for some folks.
Hey, Mark, thanks for having me on. Yeah, I appreciate the opportunity. And the space is so broad. And maybe we start with the definition of AI right now, because AI is really not, defined. You can't look up a specific definition. But what we're really seeing is computer technology is actually becoming intelligent. So it's artificial intelligence. And, for the last 10, 20 years, we've had sophisticated algorithms where a calculator essentially continues to get more and more sophisticated. But what's changed is now the computers have the ability to self-learn, and they have the ability to generate a response. So generative AI. And we're just beginning to think about the potential possibilities of what AI can do. And already they seem pretty monumental. So it's starting in efficiencies, and we're hearing companies from Tractor Supply to United Healthcare talk about removing redundancies and freeing up time for employees to focus on things that matter. So and they're talking about 25% of time, eliminating 30% of inbound calls, or getting a chatbot that answers the question correctly, or even your digital assistants like Siri and Google or Alexa, helping with everyday tasks. But that's where we're at today, and where we're going. It takes a little bit of belief, but we can see some really concrete examples that will emerge over the next 3 to 5 years. And then beyond that, it's just like the iPhone or the internet. I was looking at a newspaper from 1993 in the Google archives, and they thought at some point it's going to plug in like a lamp or a toaster, and everyone might have access to the internet. Obviously it's grown to be so much more than that over the next 30 years. But where we see it going is self-driving cars. We've talked about it. We've been, there's 11 iterations of Tesla's full self-driving, and now for their 12th one, they've redesigned it and used AI, generative AI, and the neural network to actually make it work. And they've made more progress in this version than they have in the last 11 versions combined. We're seeing.
So,
Go ahead.
yeah, I was going to say one of the things I hear quite often when I speak with folks is this the dot-com bubble? And I've been around for over 30 years, and I remember very specifically when we talked about this concept called convergence, when we're getting video, voice, and data together. And now we live with it. It's part of our daily lives. But it wasn't as much of a disruptor as people thought. There was a lot of talk about jobs getting displaced, and it was going to transform the economy. And over time, I think it came to fruition in a lot of ways, and we take it for granted. But one of the things that I quite often hear is, all right, this is an emerging, exciting technology, a new phase, likened to the Industrial Revolution in some situations. But why is this potentially different than that period, or are there some similarities?
To be fair, there are some similarities, and you could say that maybe we start to see some of the familiar signs of a bubble beginning to emerge. But we're so far from the top of the bubble, and we're so far from .com. People forget, the chip stocks rallied in 1994 and 1995, and then the entire market went on to triple before we get to the 2000, the .com bubble that everyone has burnt into their brain. And that was when we started to have these unprofitable companies come to pets.com or anything.com, and that was really the sign of the bubble. And we don't see that. In fact, the entire AI trade has been dominated by the mega cap darlings so far. And we really see that starting to broaden out as these other companies and potentially disruptive companies start to invent new things that no one's ever thought of, that AI lays the groundwork and the potential for. But as far as, we always look at valuations and we compare them to .com. We're not even close to that. In fact, the mega cap darlings, I think the last time I looked, we're trading at about 26 times earnings on a forward basis. And you have to remember those earnings, that multiple keeps going down as the earnings are going up, and they're backed by the earnings. And so we see that growth continuing, and we're not, if the bubble forms, we think not only could it be the most massive bubble in history, but it could take, the market could rally multiples higher for 4, 5, 6, 7 years before that bubble pops and we start to see the extreme fraud.
Yeah, very helpful. And what is the size? We had some famous person on the call a couple of weeks ago. I won't name her name because they don't have permission. But basically, the opinion is the AI space, if you will, is about $10 trillion right now, and the projections for the next, say, 7 years are close to 300 trillion. And that's interesting to me because, as I understand it, the global economy is pegged somewhere close to 100 trillion. So we're talking about a 3x multiple growth potential in the next 7 years of some of the projections. And I'm curious of what your thoughts are. How is that happening?
Yeah, so I'm a big fan of the person you referenced, and I sometimes $1 trillion. She has a tendency to make very bold statements, which is it's refreshing in an environment where everyone's always trying to do the next little incremental thing and misses the big opportunity staring them in the face. Some of the numbers that I look at is, so we look at NVIDIA's revenues, we look at cloud revenues, because that's the basis of AI, right? You get an NVIDIA chip, and then you have Google, Amazon, Microsoft with their cloud. And then on top of that are the tools, and then everyone else. And most of us are going to access AI in that fashion. We look at that as roughly, a sharper pencil of the numbers, call it $200 billion in revenue today. And we think that's going to grow to $2 trillion over the next 5 years. And that's because we see the use of AI proliferating and becoming truly ubiquitous. And quite honestly, Mark, I think that businesses who don't embrace AI and adopt its technology are going to increasingly fall far behind.
Yeah, I agree. I was in a meeting a couple weeks ago with some political people, and they're already kind of trying to model out for loss of what's projected as the first wave, mostly service working type things and kiosks and all that. And you see that when you go to the airport already. And AI has been around for longer than the past couple of years. It's been around for 30 years, as I learned at MIT, just not the complexity that's here and everything that's happening at a very fast pace. So in terms of someone's allocation, do you advocate, or do you think it should have some kind of a placement here for the next 7 years? And what's your thoughts in terms of what percentages of their portfolio might be appropriate?
Absolutely. So let me just talk about the equity component, because you can determine with the client, moderate risk or aggressive risk, whether they, what portion they allocate to fixed income. So speaking only of equity, I think 10 to 15% is a good starting point. You have to remember, if AI truly becomes ubiquitous, the entire market, so your S&P 500 is going to benefit as well. But I see these people that say, well, we see this bubble forming and they want to sit on the sidelines. And you have to remember, can you underperform when all the spotlight is on AI for the next 5, 6, 7 years plus, and say there's no value there, when clearly value is being literally created before your eyes in the sense of cash flow value, right? Actual cash flows. So I think 10 to 15% is a good starting point for the average person. Now, if you have someone who really does want to invest and believes in this, it would be appropriate to take it a little bit higher. And the other thing I'll mention, because as you're speaking of equities and you have a global allocation there, we do expect, the global allocation to benefit, but we really think it's going to be more pronounced in the U.S. And if we think there's structural reasons for that, and if you go back through history, or at least the last 40 years, the environment's much more favorable in the U.S. And one of the big reasons we think that's going to continue with AI is AI depends on data collection. And, in Europe and other parts of the world, there's not that ability to do that. So I think that's going to persist. So perhaps.
Yeah, let me we're about to wrap up, and I appreciate your time. I want to be very sensitive to that, but let's maybe just kind of talk about that before we end. Is that is what I am seeing. I know you're more dialed in this than I am, but because of like the European Union right now going after data privacy, and then also trying to control or legislation around the language models that are out there. Is that a detriment to the space right now, or is it just going to be that we kind of have a set of rules that we all follow across the world and try to adopt to them, with those standards that seem to be coming out every single day about the fear of this technology is equally as promising or prominent, I should say, because people are worried about the AI taking over and all the worst case scenarios that are out there.
Yeah. I do think that's going to persist, and especially in the EU around data regulation and the use of AI. They were the first to release the AI principles as well. I think that's going to continue to crimp the growth of their technology companies. But in the US, I think we haven't decided yet. And the fact that there's so much gridlock, it actually benefits AI's development right now. So I think that's going to continue to benefit the U.S. longer term. China obviously is very tight on data. You can't even use Google over there or any of our social media apps. But I think the conversation from fear of AI taking jobs is really starting to also evolve when we're starting to see these use cases where no one's job is really being replaced other than some of the frontline service people, but then they can go on and have more meaningful jobs beyond that. So it's really replacing these mundane tasks at this point. And then, you go to the future and you think, well, what about our aging populations globally and the ability for them to have a car that would drive itself, or a blind person or a disabled person? Like, they have prosthetics now that are coming out to connect to the brain and do revolutionary things. So yes, there's the fear mongering, but the use cases I'm seeing are incredible for all humanity.
Yeah, me as well. Well, I want to be really careful. Jake, thank you so much. I appreciate it. Love to have you back just to talk about some updates in this space. I know you're doing great things with Carson and the PM strategies all across the board, but this is an exciting opportunity. I'm glad that you folks are at the helm trying to come up with best practices and innovative ideas, which is exciting.
Yeah, thanks, Mark. We appreciate what you do.
Thanks. Have a great day.
You too.